Well, hi guys, welcome to this Money Control live stream. We're watching IPO Watch with me, Nandita Khemka. And today, of course, we are focusing in on the IPO of Canara Robeco AMC, a 1326 crore rupee offering. And after a long time that we are seeing a public sector AMC coming out with an issue. The mainline offering comprises an offer for sale of 49.9 million equity shares, and there's no fresh issue component. Of course, Canara Robeco is a joint venture between Canara Bank and ORIX Corporation Europe. Canara Bank, of course, will be reducing its holding in the asset management firm by 13%, while ORIX will be selling 23.9 million shares. Of course, the company has already raised almost 400 crore rupees via the anchor book, marquee investors like SBI Mutual Fund, ICICI Mutual Fund, Nippon India Mutual Fund, Kotak Mutual Fund, Franklin India MF. We have a whole host of global names as well, PineBridge Global being one of them. And of course, marquee names like Aditya Birla Sun Life and Bajaj Allianz have also participated via the anchor book. To understand the post-IPO roadmap and future growth plans, we have with us today Rajnish Narula, who's the MD and CEO of Canara Robeco AMC, joining in. Mr. Narula, great to have you right here on Money Control. First of all, congratulations on the issue. You've got great participation and some great names also participating via the anchor book. What the investors really want to know now would be where the next leg of growth will come from. Because Canara Robeco, as we all know, is an active equity-focused AMC. And as of June, you manage somewhere around 26 schemes, comprising 12 equity schemes, 10 debt schemes, and 4 hybrid schemes. So tell us, first of all, how will the mix evolve post-IPO?
Well, good morning and thank you for having me here. You're absolutely right. We are an equity-focused fund house. It's by design. 91% of our AUM is actually equity. We'll continue to be an equity-focused fund house as we go along as well. For us, the growth drivers are to start with the country doing well. I mean, that's important for the country to do well. And then, of course, markets, the broader markets doing well, and then the mutual fund industry. And within that space, we want to grow faster than the industry. That's always been our strategy. If you see over the last 5 years, we've gone faster than the industry. And we've kept pace with the growth in the equity markets as well. But the key is, of course, growing faster than the industry as well as fund performance for us.
Talking about competition that's stiff from the passive side, and of course the ETF funds as well. So far, of course, active has worked really well for you, but you don't have any presence as such on the passive side. How are you planning to capture incremental market share here on? Currently it stands around 1.5%. If I'm, correct me if I'm wrong. Are you looking at new product launches, or are you looking to tap the passive side? How are you going about, your market share plan? Mr. Narula, can you hear me?
Well, I lost you in terms of part of the question, but I think I understand the general drift. We are an active fund house and we'll continue to be an active fund house. That's clearly the focus. We believe we can generate alpha being an active fund house. There is space for passives. We will continue to evaluate that opportunity as we go along. But as of now, we are completely focused on being an active fund manager and generating alpha for our investors.
So, but you would be looking at it in future, if not right now.
Oh, absolutely. All options are on the table for us. We evaluate it at periodic intervals. And when the time is right for us, we will certainly look at that opportunity as well.
All right, and the time is right. Of course, Canara Robeco will also look at tapping the passive side. But, of course, as you mentioned, scheme performance is a key differentiator for AMCs. So what steps are you taking to sustain alpha generation and product yields going forward?
I think the key to have to the sustained performance delivery is to do with having a solid research team, have a well-driven research process with the appropriate risk management tools embedded within it. And then, of course, generating ideas that actually play out in the long term. We are a fund house that when we sell our products, we clearly position our products for the long term. So we are asking investors to look at 3 to 5 year duration with us, when they're investing in our funds. So clearly, that's the focus for us. But yeah, clearly, we look at competent management, a great businesses being, and of course, those businesses having leadership positions within those industries.
Hmm. Okay. Also, tell us, the contribution that's coming in from B30 cities, and how are you looking to scale that up? Will this also be one key focus area post your listing?
Well, B30 is actually, we've been doing very well. We already have a leadership position there. Over 24% of our AUM today comes from B30, which is much higher than the industry average of 18. We will continue to use Canara Bank as the cornerstone of that strategy for us. As you're aware, they're an extremely large public sector bank with close to 10,000 branches. And for us, we're going to use that network to get deeper penetration into B30 as well.
Okay. And of course, I think around 8% of your AUM now comes from Canara Bank. What's the comfort zone when it comes to distribution from the parent bank?
But we have a great comfort when money is coming from the parent as well. We also want to make sure that we don't have concentration with any one distributor per se. So it's a well-diversified portfolio. We work with over 50,000 distribution partners across. So we're very happy with the current range in terms of percentage of AUM that the bank contributes to us. But it's a very, very important part of our distribution strategy to have them with us.
So going forward, would you be looking to reduce dependence on bank channels and focus more on expanding the online or digital distribution side? How are you planning to increase your distribution penetration going?
Well, we'll actually like to ride both the horses, right? We want to be, getting our share of money from the bank distribution channel as well, and also be part of the digital growth as well. So we want to be on both sides. So clearly, our focus will be to growing both.
Okay, growing both in distribution sides in terms of dependence on banks as well as online channels. But let's talk about the distribution payout ratios. For Canara Robeco, it's been relatively high vis-a-vis some of the larger peers. In light of this, how do you plan to stay competitive, especially in terms of costs, margins, and growth going forward? Mr. Narula, is my voice reaching you?
No, I unfortunately lost connection there. So if you could just
Okay.
repeat your question, because
Sure.
I
I was
think
talking
we
about
had
the
a
high
bit of a confusion.
distribution. Sure, I was talking about the distribution payout ratios for Canara Robeco. It's comparatively high vis-a-vis the peers. So, how do you plan to stay competitive in terms of your growth, profitability, and margins going forward in light of the high distribution payout ratios?
No, so I think the payout that we have is in line with industry. Don't think we are very different. In our business, it's a capital light business, so therefore there is operating leverage as you grow bigger. So I think the key is to get more AUM as you grow, and as that happens, the yields also fall. But for us, it's important to be in those segments of the market that are profitable. So we actually want to compete in that space. So it's more to do with equity and longer duration fixed income products. Those are the segments that we want to be part of. And if you see our equity AUM, it's disproportionately higher as compared to total AUM. Our equity AUM market share is 2.5%, as against, if you look at total AUM, it's 1.5.
Yeah, 1.5, that's correct. Let's talk about the financials as well. You've got a strong profitability record, right? With the PAT CAGR of 55% between FY23 and FY25. With increasing passive pressure, of course, we've also discussed how you are an equity-focused, active asset management company. Are the levers in place to maintain this run rate? And in terms of revenues and margins as well, you can give us some color as to what your plans are over the next 3 to 5 years.
Well, that's a bit of a forward-looking statement, but I can generally tell you that we will continue to focus on the mutual fund space. We believe it's still a long way to go. There's a long runway ahead. As you're aware, that basically mutual funds only contribute 7% of the total market in terms of household savings as well. So to that extent, it's underpenetrated. Even in terms when you look at the industry AUM as compared to GDP, we are roughly at about 20% or thereabouts, whereas a market like the US is 124%. So a long way to go. So we are focused on what I call as the main space, which is the mutual fund space. We do have the ability to bring in other new products, which are high margin products like the AIF structures or an SIF. Those are all on the table for us. They're all bouquets that we will look at going forward to increase margins if necessary.
I think any aspirations in terms of margins? I think it's 65.2 as of FY25, 65.4%. I beg your pardon, as of FY25. Any aspirations in terms of that? I'm talking about EBITDA margins.
Yeah, I think while margins are important in our business, to me, I think profitability of PAT is and cost to income ratios are better ratios to look at. Our cost to income ratio actually has come down from 50% about 2 years ago to about 34.6% now. So it gives us huge operating leverage. And PAT, as you rightly mentioned, has grown tremendously as well over the last 2 to 3 years.
So you have more headroom in terms of your cost to income ratio going forward. Is that what you're saying?
Absolutely. I have the ability to spend more if I need to in things like infrastructure or people or talent. So we have enough headroom there.
Sure. Despite a high equity base, your revenue yield is at 0.4%, if I'm not mistaken. That's relatively lower vis-a-vis peers. Would you be looking at sprucing up this metric going forward?
Well, actually, we're very comfortable with where the yields are for us. And quite frankly, in our business, yields need to be looked at a little differently. So let me illustrate it with an example. So if you buy a phone, and suppose the yield for the manufacturer is 100 rupees on the phone, the day the manufacturer sells the phone, the 100 rupees is realized. There's no incremental money or margin that goes or accrues to the manufacturer. In our business, if I get a block of business in which I earn 100 rupees, I have the opportunity to earn the same 100 the next year, another 100 the year after, because if the investment stays with us for the horizon we are hoping, which is 3 to 5 years, I continue to get yield every year on it. And because I'm equity focused, I have the opportunity in case the markets go up for the yield to actually increase. So quite frankly, margins in our business needs to be looked at differently as you would look at for a manufacturing firm. So therefore, the more important ratio is cost to income, how you're doing there, and profitability.
Okay. Got it. Of course, being an active equity, being largely into active equity funds, of course, your performance is sensitive to equity market cycles as well. In volatile times, how do you ensure continued stickiness in retail flows?
I think that's a great question. I think the market and the investors themselves have evolved. So, in the past, when you would have choppy markets or volatile markets, you would find some investors who are risk averse actually moving out. We see that there's more and more tendency for people to stay invested. So to me, when markets, go down in a way, it's only a notional loss that is there for an investor as long as they don't redeem. If they hold the money through, we do know markets go through cycles. It's a great opportunity to pick it up on the way back as well. So we are very, very confident about the fact that as an asset class, equity will outperform every other asset class 7 out of 10 years. I mean, that's our belief, and that's why our business model is based on that.
What are the SIP trends? I think 31% of your AUM constitutes SIPs, if I'm not mistaken. How do you see that panning out?
Well, SIP is to my mind, the future for the industry as well. We have a disproportionate share of SIP contribution to our AUM. Close to 30% of our AUM comes from SIP itself. And clearly, that's the building block for our business. And again, the Canara Bank channel there for us is extremely important because our SIP strategy is also designed in a way to be largely proposed through that channel as well.
All right, last question then. Mr. Narula, your RHP, I was just going through it. It says that mutual funds have experienced a substantial increase as a proportion of household financial savings, growing from 2% to around 7% between FY21 and FY24. of course, with the investment value expanding at a CAGR of 55%. Now, post the recent GST cuts, as household savings increase, what is the industry outlook? Do you think more money will now get channelized into mutual funds and financial savings, and not just consumption?
Yeah, it's my hope as well. Clearly, these structural reforms have great benefit to the consumer itself, and it's largely passed on as well. So we do expect household savings to increase. We do expect mutual funds getting a higher share as well. And clearly, I think the tagline that AMFI has for us, mutual funds are here, will stand us in good stead.
Sure. Any other message to your prospective shareholders?
Well, I think it's a great day for the company. It's a great milestone. We've actually turned 18 last month. So in a way, we are actually good to fly from the shadows of our parents in a way. It's my hope and desire that people who invest with us will look at our shares as something that they will hold on for generations, because that's the kind of institution we're building. We're building an institution that survives time. And hence, I think it's, to my mind, a great opportunity for the public as well as our staff to be able to participate in this IPO.
Sure, and we would like to congratulate you on that, Mr. Narula. Wish you all the best for the IPO as well as the subsequent listing as well. And I look forward to our future conversations as well. Would like to thank you for taking out time and joining us on Money Control and sharing your thoughts with us. All the best.
Thank you very much.
Thanks a lot. Well, with that, we've come to the end of this edition of IPO Watch, Canara Robeco AMC. That was the IPO that we were focusing in on. We'll, of course, be getting you a whole host of other IPOs as well, as and when they open up. So keep watching the space for all the latest on the primary markets. But with that, thanks a lot for tuning in. Stay tuned to Money Control for all your other news and updates, and I'll see you later. Thank you.